Chapter 7 here, we're going to wrap up. And so I gave you a quick definition last time on rational expectation. How did that compare to a adaptive expectation?
Adaptive was formed with past experience or data, and then the rational was formed with all available information.
Okay. So that's the main thing. So does the rational include the adaptive? Yes. Right? And so we're going to use that previous data also, but then in addition to that, there might be other information that we have as well. All right, so let's see if I can just look at this video here. Oh yeah, this is it. Okay, that'll be fine. We'll get that later. Okay, so if we're using all information, the idea is that a variable will contain that information, like the price, is what we'll be kind of focusing in on here. So if an expectation uses all available information, there is no room for oh, I guess I'm going to put free profit, for lack of a better word. I was going to try to generalize this more, but so if we think there, our error term is going to be small. So one of the predictions we'd make is that we have small errors. Small forecast error was the forecast. Small forecast error. And normally distributed. Error. Now, you guys might be a little foggy on your statistics class. Does any of that mean anything to you that I put on here? Forecast error and normal distribution? Normally distributed error, what is that? Yeah, so back to the bell curve concept. So the bell curve concept helps highlight that. So a normal distribution is that you've got this bell curve. And what is the bell curve measuring here? What is the height of the bell? The average, yeah. So it's the most probable number, right? So it would be your prediction. So this variable x might be your forecast. That is your predicted value. So sometimes we put a little hat on it. X hat is the predicted value. And this is we're measuring probability over here. And so that variable x, if we're thinking about the commute time to Lawrence. And so the variable is commute time, and so we think it's going to be about 30 minutes, given all of our available information. We've checked Google, we know it's not raining or whatever. We know the weather, we know our car condition, as far as the chance of our car breaking down, the chance of getting a speeding ticket, or we factored in that we're not going to go more than Russ's recommended 9 miles over the speed limit. So we've kind of factored all of that in, and we've got a 30-minute commute. And so in all likelihood, maybe the probability of getting there in 30 minutes is 80%, right? So 0.8 is the probability that we're going to get there in that amount of time. So are we going to be always there right on the dot at 30 minutes? No. So the point with this is that we're going to be wrong, but we're not going to be wrong by anything we could have known ahead of time, right? So only unexpected things is what's going to cause us to be plus or minus. And we have just as good a chance of it being, let's say, 31 minutes as we do it being 29 minutes. That's what we mean by even sides of the bell curve. It's less likely that it'll be 29 minutes, right? The probability of it being 29 minutes is less than what it would be for 30. But we can't predict, we can't squeeze any more data out to make a better prediction than a 30-minute commute. So that's kind of the nature of rational expectations, is that we get to a point where we're going to have a price of a stock or something, and then we're going to say, is there any other information that could say, oh, it really shouldn't be 129 for Apple, it should be 133, so I should buy it today, right? That's what stockbrokers do every day. They're trying to make bets on, is it going to go up or is it going to go down? Because you could be on the short side of the market or the long side of the market. So if we kind of put a stock price into this analysis, if it's currently at $30, that's the most probable thing. It's equally likely that it could go up to 31 or go down to 29. We can't know that information, right? It is at the price that it's at on Wall Street is because we got a whole bunch of people that are profit-minded that are squeezing out every little detail of every little thing that's related to the stock that we're looking at. And if there is something that looks profitable, what do they do? If there's real information that comes to the table, what do? They buy it, right? Like this. Like sometimes we get down to microseconds of purchasing stocks depending on movements. And so that price is going to gobble up that information and move just a couple pennies or something, right? So the price that's stated on the market at any given point in time captures all relevant information in the market. That's the argument of the efficient market hypothesis and rational expectations. Okay, questions or comments there so far? All right, let's see. I wanted to do this rate of return calculation. All right, this is where my eyes thing gets here. I think I can handle this one, but I always like to put the right subscripts and superscripts so that it's consistent with the text. So I just can't quite do it. There, all right, R-E. All right, so let's look at rates of return. So how do we calculate the rate of return of a stock? Like how much money did you make? What would be the rate of return calculation? Go ahead. Well, I want to stay away from bid and ask because you might be holding on to this longer. So not bid and ask is at the given time that captures a little bit of a fee. Isaac?
Is it price you sell it plus dividends divided by the price you bought it?
Close. Daniel?
What it's worth now minus what it was worth when you bought it, and then divided by the difference?
No, went off the rails there at the end. You're real close, Bryce.
What is worth now minus what's divided for
Divided new number minus old number divided by old number, just like macro class with inflation or GDP, the growth rates of GDP, all of that stuff is rate of return. It's all the same number. So it's rate of return in general. And in fact, let's just go ahead and do that. Whoops. Your textbook uses an R. So R, the rate of return, is the new number minus the old number divided by the old number in general. Just to kind of always have that off the top of your mind. New number minus old number divided by old number. Okay, and then more specifically then to a stock, we can add in, or a bond for that matter, a dividend or a coupon payment. So the rate of return for the stock is PT plus 1, so 1 time period ahead, minus PT, new number minus the old number. But then we're also going to add a dividend or a coupon payment, which your textbook just is going to put C, but it could be a dividend payment too. I'll define the variables for me after we run it out. Now divide that by the old number. And so that's your rate of return. So R equals rate of return for the security held from T, time period T to time period T plus 1. T plus 1 is the price at the end of time period, because we're only doing one period out. PT is the initial price of the security, what we bought it at. And then C is some sort of cash payment during the hold time. So this would be a coupon or dividend. Okay, so now, any questions on that? If we're now deciding on whether to buy a security before we buy it, we're forming an expectation on the rate of return. Which one has an expectation of these terms here? Which one are we putting a bell curve on up here? The price of the new, right? So that's the only thing. We're trying to predict what the price is going to be in the future, which is then going to slap a bell curve on it that it's not, we don't know for sure it's going to be that. So the expectation of the rate of return, and then this will get back to comparing it to our opportunity cost, is basically the same formula, but just do T plus 1 expected minus PT, which is known. The coupon payment could have an expectation on it, but we don't put it on because it's usually pretty stable over that one time period. They've declared that it's going to be that. And over PT. So now the only difference here between this one and this one is this is X post, and this is X ante. Who remembers those Latin terms that I used in a few previous classes here? What was it, JC?
Post is off the ante.
Post is after the fact, ante is before. So the Latin terms, ex ante, ex post. So the formula is the same, except with the modifications of this is before the fact, that's after the fact. Okay, so that's our rate of return. And so the if we compare the optimal forecast, just to throw in a little bit of what the book does here. So now we can compare so imagine there is an optimal forecast. which the textbook uses of, it's OF, is an optimal forecast for the rate of return. The optimal forecast uses all available information. So, if the optimal forecast is greater than the current price. So I'm using now, throwing in R star, and I'm just following the way the textbook does it, by the way, so when you read this in the textbook, it'll be the same thing. So, but the textbook doesn't do what I'm doing here. So this is the equilibrium price, so current equilibrium return. The current equilibrium. So using all the information, we think the rate of return on this stock is predicted to be higher than what it currently is given the current pricing structure, right? If that's the case, what's going to happen to the price of the stock? It's going to go up. So if that's the case, that would imply, so this is kind of thinking the math notation of implying this situation implies that there'll be an increase in PT, right? So people are going to be buying the stock today because we've learned some information or whatever, the return seems to be higher. And so people are going to start buying the stock today. If people start buying the stock, it drives up the price, right? I won't even put in the supply-demand stuff here this time. So the demand goes up, price goes up, and what happens to the rate of return? It goes down. So if we go back to our formula here, if this is going up, the rate of return is going down. So an increase in the price leads to an decrease in the rate of return. And this is the optimal rate of return. And so we're doing this to just show the natural correcting mechanism that's going to come in of why the current price today, PT, reflects the optimal price. It's the price that the stock should be if we believe we're operating in a world where we have optimal forecasts going on all the time, because people have incentive to figure that stuff out and use all the available information. So same is true here, just to be complete, but if the optimal forecast is less than the current expected rates of return, then that's going to lead the stock price to fall today, which will lead to an increase in the optimal rate of return, the optimal forecast on the rate of return. So, therefore, our three dots are therefore, the optimal forecast is equal to the market equilibrium. That's our prediction. Which means in an efficient market, one that has lots of buyers, lots of sellers, good information flow, all unexploited profits, are eliminated, are gone. There are no easy money. There are no unexploited profits. They get gobbled up as soon as they're there. Okay, questions or comments on that? For those of you who are in the stock picking business, actually, we're going to do a a PGD. We're going to be targeting the freshman sophomore, so I don't think any of you will be there. But we're going to do a version of this for all of those incoming freshman sophomore playing with Robinhood and single pick stock picking, and we're basically going to give a lecture, something along these lines. And I'm not going to do this, of course, with freshman sophomore.
Can you do that for the older kids too? That sounds like fun.
We might, yeah, we might. We'll see how this one goes. But we're going to do a critical thinking thing. So Justin's going to do the first half on it and kind of common fallacies and problems, people not understanding probabilities and making bad decisions. And then we're going to get into kind of stock picking and efficient market stuff as part of it as well. So yeah, it should be good. All right. So, question for you, will new favorable information lead to an increase in price of a stock? So new favorable information, will that always lead to an increase in the price of the stock?
Because the favorable information that the stock's going to go down to, so.
No, I mean, it would be positive information that comes out about the stock. It wouldn't be about it falling, if I understood you right. If it's what?
Big enough.
What do you mean big enough?
I think the use is big enough to change the impact.
Big enough relative to what?
Relative to the people buying the product.
No. Look.
Yes, if like the expectations are expected to show that growth. Does that make sense?
Yes, I mean that's where I'm kind of going with it. So, for example, if a stock is, they haven't made an announcement yet, right? And so, but expectations are such that we believe that sales are going to be up 30%, and the quarterly earnings report is coming out Monday, right? Monday comes along, and good news, the quarterly earnings are up 20%. What happens to the stock price? It goes down according to rational expectations. Why? The current price of the stock, PT, had built in a 30% expectation. So when the actuals came in at positive 20%, which is still good, but not good enough relative to what was expected before, and so the price of the stock would fall. That happens a lot on Wall Street, actually. When they don't meet certain earnings potential, it still might have been positive, but not positive enough relative to what was expected. So the point that we're trying to drill in here is that this price is efficient. It is reflecting all available information at any given point in time when we look at the ticker tape and Google up stock prices. Okay, any other questions or comments there? All right, we're gonna watch a video. Let's see. Where's my clicker? Not a clicker, but it's in the box. Oh, that's because I got this. Oh my gosh. All right. Stop. All right, there we go. Okay, so this is from, I can't remember the affectionate name of this. I think it's MBAbullshit.com.
Hello and welcome back again to MBAbullshit.com. So the topic of this video is the efficient markets hypothesis, also known as image. And this is the basic video before you move on to a more advanced video on the efficient markets hypothesis. Remember, you can always go back to MBAbullshit.com. All right, so let's get down to it. Now, before this video, it's best that you already know the meaning of fundamental analysis and technical analysis, also known as chart analysis, as tools for predicting share and stock price movement. Share and stock is the same thing. Some people say share price, some people say stock price. So make sure you know these two forms of stock price analysis before watching this video. Okay. Now, this basic video discusses the basics of efficient markets hypothesis, as well as the basic differences between strong market efficiency, semi-strong market efficiency, and weak market efficiency. Now, I know these words sound pretty intimidating right now, but don't worry, you will see how easy and simple it actually is. I want to show you the examples. All right, now my next more advanced video will still actually be super easy, and you can find it at mbabullshit.com, and it simply and easily explains how stock and share prices move up and down in efficient markets, depending on people's expectations. All right, so now let's get down to it for this basic video. Okay, first of all, it's best to recall basic stock investing. Okay, now basic stock investing or basic stock playing or trading or whatever you want to call it, or whatever type, they're not exactly the same. But anyway, in basic stock investing, it's a game of good news versus bad news. Now, what do I mean by that? Well, it depends on sales reports, for example. Sales reports, income reports, any or profit reports, if you want to call it. Anyway, what does this mean? It means that the good news or bad news regarding sales reports or profit reports are directly related to stock price. Okay, so basically, if the sales reports are good or the profit reports are good, then the price of shares are supposed to, or in theory, the price of shares or stocks go up. Okay, but if the sales reports show that, or the sales reports of a company are bad, then the share price or the stock price of that same company should go down. All right? So now, how might people earn money using the news? Okay, how might people earn money using the news? Well, let's just look at this story about Greedy Bob and Greedy Bill. All right? Now, let's say that Bob here is the CEO of a company, and he sees the latest company sales reports, and he sees that the company is doing great. Okay? Let's just say that this company that Bob works for is listed in the stock market. All right? So Bob, the CEO, sees the latest sales report, and he sees that his company is doing great. What he might do is he does not announce this report to the public yet, and instead he tells his buddy Bill about this great sales report before telling the public. Now, what does Bill do? Okay, Bill buys the stock or buys a share of stock before the news announcement about this company's great sales report. All right, just make that more visible here. Before this great sales report, and then what happens? Bob then decides to announce it to the public, and after the news announcement, the share price goes up. And what happens to Bill? Bill gets rich quick. Why? Because he bought the stock before the news announcement, and then there was a news announcement, and then Bill's share price went up. So Bill gets rich quick. All right? So that's one way people can earn money by trading the news. All right? So basically, this is a story about Greedy Bob and Bill. What actually happened here? Okay, what actually happened here? Well, number one, Bob, the CEO, learns about the good news. At first, he tells only his buddy Bill about the good news. Bill buys the stock in advance, and then Bob announces the good news to the public, to people like your grandma, or very often you have these grandma investors who don't know much about the inside information of the company, about the secret information of the company. And then it's only after people like grandma hear about the news that the stock price goes up. And then people like Bill over here get rich quick. And grandma here, okay, did not get rich quick because she heard about this good news already after Bill made money on it. So in other words, people like grandma hear about the news too late together with everyone else. Okay, so she's not so happy over there. And you might say, why doesn't she earn money? The stock price still went up. Well, in theory, remember that it's stock trading. For you to win, someone else has to lose. Okay, because you buy the stock cheap, or Bill here buys the stock cheap, and then he sells it expensive. Okay, who does he sell it expensive to? Well, he sells it expensive to people like grandma after the price has already gone up. So it's theory anyway. In stock trading, for you to win, someone else must lose. In this case, Bill won against grandma. So in theory, Bill bought the stock when it was still low priced before the announcement, and then sold it to grandma at a high price after the announcement. Okay. However, this is actually what happens. Okay, this does not happen in what we call an efficient market. Okay, so or another way of saying it is, we saw this bad situation over here. Okay, but actually in a perfectly efficient market, that would not happen. This bad thing that happened over here, this bad situation between Bill, Bob, and grandma, this would not happen in a perfectly efficient market. Why? Because in a perfectly efficient market, there's number one example, there's good news. And then number two, even if Bob is the CEO, Bob, Bill, and Grandma all learn about the good news at the same time, even if Bob is CEO, okay, in an efficient market, or in a perfectly efficient market. Why is that? Because in a perfectly efficient market, all right, so the keyword here is perfectly efficient, all relevant information about the company, okay, such as the sales report, okay, flows or moves or travels instantly or super quickly between Bob, Bill, and Grandma. So Bill does not have an advantage, even if he's the buddy of Bob, which is CEO. All right. Now, in MBA bullshit language, all right, in business school bullshit language, okay, instead of saying perfectly efficient market, we usually say strong market efficiency. So if you're in business school, you're wondering what this strong market efficiency is that the textbook or your professor keeps on talking about. They're talking about perfectly or almost perfectly efficient market, like this situation over here. Like this situation over here, where they all learn about the information at the same time, or almost the same time. Okay, so what does this mean for investors? It means that in a perfectly efficient market with strong market efficiency, at any one time, anyone and everyone already knows all relevant information about a share of stock. So nobody can earn money by using any information, such as this sales report over here. Okay, the sales report over here. Okay, nobody can earn money using this information to analyze and predict the future share or stock price movements, either up or down. So people like Bill cannot use that information to beat Grandma. Why? Because Grandma already knows the same information too, at the same time that Bill knows it. So it's useless to use inside information. Now, what is inside information? What's the difference between information, or what's the difference between information and inside information? Inside information just means the secret information that only Bill and Bob know. Okay, Grandma doesn't know yet. Secret, inside means like secret information or advanced information that Bob knows. But in a perfectly efficient market with strong market efficiency, it is useless to use inside information, fundamental analysis, or even technical analysis to give you or to give Bill an advantage in stock investing. Why? Because fundamental and technical analysis are based on information. And since these two are based on information, how can these two give you an advantage if the information you are using is already known by everyone? Remember, in stock market investing, okay, you have an advantage if you know about this information before other people know it, right? Therefore, Bill also does not have an advantage when he uses fundamental analysis, which uses that information, and he also does not have an advantage when he uses technical analysis, which also uses information, or which is also based on information.
All right. So,
everyone,
I think,
remember,
JC,
it's stock
you
market.
brought up technical
They're
analysis
these two.
too. So this is kind of an important part of the efficient market hypothesis, that all the looking for trends, and I have a buddy that I was going to try to have a beer with this weekend at some point, but I think he's kind of thrown in the towel a little bit. I think he still dabbles, but he was taking classes. He didn't have a college degree. He works on boilers and stuff, so he went to trade school. But he was totally into finance and making money in the markets and doing, candlesticks. And I like to just listen to what he said, just, all the stuff that he was learning. And this is kind of an important conclusion to that you can't outdo the market consistently. And so you might get lucky once in a while because there is a normal distribution on it, right? So you've got 50-50 odds that whatever you do might work, and it might work a few times in a row, kind of like flipping a coin. And so you start to see, oh yeah, this stuff works, and there's lots of super smart people that have come up with all of this technical analysis and fundamentals, but that is all trading on existing information. And so if everybody else is doing that too, then there's no real edge to it to gain. Okay, comments or questions on the video? Yeah, Jonathan? How what?
Chef?
Oh, insider trading.
Yeah.
Oh, yeah, right. With the insider trading, yes. So the inside trading, and that's why that stuff is illegal, so that we don't have that. Now, the stronger you have an efficient market hypothesis, you'd even say that doesn't matter. But obviously, that's the inside information before it gets leaked. And yeah, that's kind of the grandma story. And so that's against the law, even though, yeah, that would be the perfect thing to be able to do. And
Yes.
somehow congressmen and congresswomen have profited pretty well over time because they have, insights onto that, and then they might just tell their nephew or niece or uncle or whatever some of the new policies that are coming down the pipeline. I heard Toyota got nailed today on the news, so something with emission standards or something. It sounded like a bigger deal than Volvo on. So really, Toyota prices have probably gone down from that busting. So, JC?
There's also the people that trade on news, like especially with the Fed or FOMC talk, but then have to tell you the exact time where they're going to talk. So people trade that in the stock markets when they talk, it spikes or drops. So people trade literally in a second and $1,000 in a split second.
Yeah, yep. And so, but with more and more people doing it in a split second, then we start to get right back to the efficient market hypothesis too. And then, but now I have a faster computer use, so my microsecond beats your microsecond, and then, but eventually they all end up, competition kind of drives them together as well. So, so I put this quote on the board here. He said in there, for you to win, someone else must lose. That was in the grandma thing here. You guys agree with that? Because that doesn't sound like the type of thing I usually
Gets
do.
rich.
Wait, there's grandma. Let me get grandma on here.
Price goes up.
So we got grandma. For you to win, somebody else must lose. So grandma sells or something. I thought I've been espousing win-win situations with markets.
So is
What's that?
that always the case?
Isn't always the case. So yeah, if grandma was voluntarily buying or selling, and granted we had a little inside information here, right? But did grandma, someone else must lose? Is it a zero-sum game? Zero-sum game means someone's wins is another person's losses. My claim, since principles of micro that you guys have had, is that market transaction creates a win-win situation. Daniel?
I think that yes, somebody else has to lose because it's not an unlimited money supply.
Well, what else goes into the transaction in terms of analyzing the wins or the losses? I guess is one thing to look at with grandma and the insider trading. JC? The spread, yeah, but that's net of the spread. So that's another win from another party. But I want to focus in on grandma and Bill, because I think he's portraying here that his wins is grandma's losses. Him being able to trade on inside information is grandma's loss. So first of all, does grandma ever realize that she lost some money? No. No, she doesn't, unless maybe this comes out or something, but it's just that the price started to go up and she wasn't able to partake in it. Even if grandma sold, she would have had something else to do with her money, right? And so she sold for a reason to put it into another opportunity that she perceived was higher, right? So when we get into these future prices and stuff too, again, we can't judge a decision ex post. So I woulda, shoulda, coulda, like my decision not to buy more Bitcoin, which has continued to skyrocket since this is finance class. Let me check where it's at today. I was talking with Justin. See, oh, I don't have the coin camera. 262. Okay, so, oh wow. Okay, so Bitcoin went down, went up, man, what a friggin' roller coaster ride that is. It's at 36,000, down 5,000 from earlier today. Let me switch this over.
What the heck?
This is for the week. Here's today. It was at 39,000, and now it's at 34, which kind of surprises me. I thought with Joe Biden's announcement, did you guys hear his announcement? Since we're talking about policy.
The 1.9.
1.9 trillion, minimum wage $15, and extending unemployment benefits through September of 400. Nobody can be evicted or let out of their place till September. How about write this thing through together? Blah, 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 blah. So,
Yeah, let's shrug. baby.
Dakota. Yeah, I know. It really.
Shrug, baby.
Once you started going down the
Oh my
list,
God.
now some of you haven't had the Atlas Shrugged. That's going to be this fall for entrepreneurial economics. But it is funny that I thought the same thing, Luke. I'm like, oh my
Then you got
God.
Elon Musk. He's so much like Hank.
Can't do this. Yeah, it's.
We're in the book.
What did Elon Musk do?
But it's just like he's like the Hank Gruden right now.
Okay.
But like he's just by himself doing his own.
Okay, Dakota, you had a question.
Yeah. Over the past like months, why is it fluctuates? Like, I see big-
So here's the month.
I saw it like 42,000. Like,
Yeah, so it's at 19,000 just a month ago. And so even where it's at 36, it's still up here. So the changes of the economy, I think, are one thing with the presidency going over. So as people become more and more understanding of Bitcoin, they start to realize it's a fixed supply and it has value and it can't be corrupted. I'm not willing to put large sums of money into that bet at this point because I think it's still very speculative. I don't know where it's going to end up. I'd have to say I'm starting to become a little more comfortable that it's going to end up being pretty solid, but I just don't have enough. Well, solid. I know it's going to be solid. Don't get me wrong, but I don't know if equilibrium is at $10,000 per Bitcoin or if it's at 80,000. I have no freaking clue. Like you talk about a bell curve, to me that's it. There's not enough information as an economist for me to make some sort of prediction with it. It's just it's a wild card. So I don't advise anybody to invest in Bitcoin. Although I did it for fun for the $100, but.
Well, wait 2 seconds. Let me go back for like 1 second to the Joe Biden thing. You said a minimum wage of $15. That's not like all across the United States.
All across the
No,
United
it's
States
federal.
is what it was federal minimum wage. Yeah.
So like, when does that take place?
Well,
Hasn't been signed yet.
he didn't even say it. It was just his little rah-rah speech.
Is
So,
that our really-
but here's the thing that was significant, if you guys haven't paid attention to politics, is that with that runoff in Georgia, the Democrats have the Senate and the House. So what that means in terms of our checks and balances is that normally, Trump puts up a policy, the Senate shoots it down or whatever, or there's some sort of thing. Well, now that it's all Democrat, it's going to be a lot easier for them to put some of these big government policies into place.
It can't be enough to shoot up our cost of living.
Yeah. So anyway, if we expect that that's inflationary, all of a sudden things like Bitcoin and gold for that matter and other assets start to look like potential good investments. So that's why I think Bitcoin has gone up even in the last month, is that we're starting to see some of that come out. And COVID, the vaccines things are a little more stable, but all right, let's get into these exercises here. So I've got some problems for you.
So after spending a week in Vegas 2 weeks ago, I hate how expensive food is there in the first place.
Yeah, you were on the strip.
No, I wasn't on the strip.
Oh, you weren't even on the
I
strip.
was on the strip. But like just normal restaurants and stuff there and cost of living and stuff.
Open their eyes.
Oof, I don't want to happen here. Yeah, but I mean, it's not from
I mean,
like
like my apartment, the house is in the house.
the house that is 1,200 square feet.
Okay, so we got some problems here for you to work through. So you guys can work with your neighbors, you can move your chairs around if you want or whatever. You're going to use the Gordon growth model here on one. Well, the first one's not quite Gordon.
You're good at this stuff, Jason.
Which one are we on? All of them. Yeah, we're going to do all of them. So,
Do it like names on them because we're turning them in.
no, I'm going to have you guys keep these. So you can kind of use them. We'll go through them today. And might come in handy for your homework and tests. Oh, you guys on Zoom. I kind of forgot about you. Okay. I've got the problems on here, and I did not bring my.
So this is the one period evaluation.
So this is a second one's
Yeah. That's the answer value.
Okay. Easier.
Yeah, it's on my computer. Let me go. I'm gonna go run to the office, you guys. Can you read the screen? I'll write the first one and then I'm gonna go grab my laptop.
Yeah, that's what we need to
And then you guys can work as a group in your group. I'll put you in your own little room. All right, so compute the price of a share of stock that pays $1 per year dividend that you expect to sell for $20 in 1 year. Assuming you have a 15% required return. All right.